Hi everyone, today our group will be presenting our Portfolio Optimization 2 results. The goal of this project was to determine how different combinations of the same 10 stocks affected portfolio's risk and return characteristics. This addresses the first step of the data analysis process, which is identifying the problem. Specifically, we wanted to understand how investors can use diversification to build more efficient portfolios and evaluate performance using risk-adjusted return measures. To complete the project, we used Python to download stock price data and Fama French factor data from the Kenneth R. French data library. We then generated 10,000 random portfolios using different weight combinations of the same 10 stocks and calculated key metrics such as expected excess return, standard deviation, beta, Sharpe ratio, and Treynor ratio. We also used Tableau to create visualizations that helped us analyze and compare the portfolios. Artificial intelligence played an important role throughout the project. AI assisted with coding, debugging, and organizing the data analysis process, allowing us to focus more on interpreting the results and understanding the financial concepts behind the calculations. In the remainder of this presentation, we will discuss how the portfolios were generated, explain the key performance measures, compare the Sharpe and Treynor ratios, analyze our Tableau visualizations, and summarize the main insights we learned from this project. In this part of the project, we generated 10,000 random portfolios using Python. Each portfolio contained the same 10 stocks from part 1, but with different weight allocations. We used the NP random method to generate random weights and then normalize those weights so that each portfolio was fully invested and the weights summed to 100%. Simulating thousands of portfolios helps us explore many possible combinations of the same assets and approximate what is known as the efficient frontier. Rather than evaluating only a few portfolios, we can observe how risk and return change across a large set of investment choices. To evaluate each portfolio, we calculated several key metrics. The first key metric is expected excess return, which measures the portfolio's expected return above the risk-free rate. This represents the additional reward an investor expects to earn for taking on risk. The second metric is standard deviation, which measures total portfolio risk. It captures how much portfolio returns fluctuate over time, with higher values indicating greater uncertainty and volatility. The third metric is beta, which measures systematic risk or the risk associated with overall market movements. Unlike total risk, systematic risk cannot be eliminated through diversification. Together, these metrics allow us to compare portfolios not only by how much return they generate, but also by how much risk is required to achieve those returns. These measures provide the foundation of the Sharpe and Treynor ratio analysis discussed later in the presentation. After calculating the expected excess return, standard deviation, and beta for each portfolio, we evaluated performance using the Sharpe ratio and Treynor ratio. The Sharpe ratio measures a portfolio's excess return relative to its total risk, which is represented by standard deviation. It tells us how much additional return an investor receives for each unit of overall risk taken. Because it considers all sources of risk, the Sharpe ratio is most useful when evaluating an entire portfolio. The Treynor ratio measures excess return relative to systematic risk, which is represented by beta. Rather than looking at total volatility, it focuses on only market risk, or the risk that cannot be diversified away. For that reason, the Treynor ratio is more appropriate for investors who already hold diversified portfolios. One interesting result from our analysis is that the portfolio with the highest Sharpe ratio was not the same portfolio with the highest Treynor ratio. This occurred because the two measures evaluate risk differently. The Sharpe ratio focuses on total risk, while the Treynor ratio focuses only on market risk. Overall, these results highlight the importance of diversification and show that portfolio performance should be evaluated using both risk and return. Depending on an investor's objectives and risk preferences, a different portfolio may be considered the most efficient choice. For my section, I'll discuss the two Tableau visualizations created from the 10,000 randomly generated portfolios. The first scatter plot shows portfolio standard deviation on the x-axis and expected excess return on the y-axis. Standard deviation measures total portfolio risk, so this chart helps us evaluate how much return investors are receiving for the overall risk they are taking. Each point represents one of the 10,000 portfolios generated in Python. The color scale represents the Sharpe ratio, with higher values appearing in warmer colors. The portfolio with the highest Sharpe ratio is highlighted with a red star, while the portfolio with the highest trainer ratio is highlighted with a blue star. The location of these points help identify portfolios that provide strong excess returns relative to their level of total risk. The second scatter plot shows portfolio beta on the x-axis and expected excess returns on the y-axis. Beta measures systematic risk, or the risk that comes from overall market movements and cannot be eliminated through diversification. In this visualization, the color scale represents the trainer ratio. The portfolio with the highest Sharpe ratio is marked with a red X, while the portfolio with the highest trainer ratio is marked with a blue X. This allows us to see which portfolio provides the greatest excess return relative to their exposure to market risk. Together, these visualizations demonstrate the risk-return trade-off across all 10,000 portfolios. In general, portfolios with higher expected excess returns also tend to have higher levels of risk, whether risk is measured by standard deviation or beta. The chart also shows that portfolios with the highest Sharpe and trainer ratios are not the same. Overall, these results highlight the importance of considering both return and risk when selecting investments. Depending on whether an investor is focused on total portfolio risk or market risk, a different portfolio may appear to be the most effective choice. To conclude, our analysis demonstrates the importance of diversification in portfolio management. By generating and evaluating 10,000 different portfolios, we were able to see how combining the same 10 stocks in different ways can significantly change both risk and return outcomes. Our Tableau visualization showed a clear risk-return trade-off, where portfolios were higher expected excess returns generally required investors to take on higher levels of risk. However, the results also showed that the portfolio with the highest return was not always the most efficient choice. We found that the Sharpe ratio and trainer ratio provide different perspectives on performance because they measure different types of risk. The Sharpe ratio focuses on total portfolio risk, while the trainer ratio focuses on market risk. The main takeaway from this project is that investors should evaluate returns in relation to risk. The goal is not simply to earn the highest return, but to identify the portfolio that delivers the best risk-adjusted performance.